We are on the brink of World War III. Inflation is running rampant. Food shortages loom. Are we overdue for a global economic collapse? Let's get into it.
One stacker on a journey to find silver. International Stacker.
Ladies and gentlemen, we are here again to have another fantastic discussion with one of my favorite guests ever, Lior Gantz. He is the founder of the Wealth Research Group, and he recently released a full economic outlook report for 2022. Links in the description. Lior, welcome to the channel, man. How you doing?
I'm doing well. How are you?
I'm fantastic. You tell the viewers who might not know who you are, which I find hard to believe because you're a legend, but can you give us a quick synopsis about you and your history?
Yeah. By mistake, I got into finances and investments when I was 16 years old, because when I was 13, my father's business went under and I started working. And living under the roof of my parents, I started working and actually saving. So babysitting, painting like wood decks, and handing out flyers. I did everything, delivery services, whatever. But by the time I'm 16, I have this money saved up, and I'm coming every month to the branch, and I'm depositing this. And this banker asked me, like, how do I do it? And I told him like my story. So he said, bring your parents, they'll sign a waiver. As a minor, you'll start trading equities. Now, this is June of 2000, so we're literally just starting the dot-com collapse. And he's like he's printing out his little fax machine like mutual funds about China being the next big thing. And so that's how I got started in investing. He gave me like directions. He told me read Warren Buffett, read Peter Lynch. So I was one of those kids in high school where you got the history book, and inside of it you got like How to Beat Wall Street by Peter Lynch. And that's how I got into investments. In 2015, so this is 15 years later, age 31, I saw how incredibly different my education during my 20s, self-taught, is from my friends who went to uni or stuff like that in terms of financial literacy and history, etc. And so once the Fed raised rates, December 2015, I said, this is a very good time for people to understand what this means. And we're literally at the same junction, right? The Fed just raised rates. And so I founded Wealth Research Group as a free financial newsletter to basically take what I'm looking at, reading, researching, and deliver it to the inboxes of readers who want to know what's going on in my world. And since then, it's also developed into sharing like personal stuff in terms of things that I'm invested in, things that I'm looking at. So personal portfolio as well. So that's Wealth Research. Basically, it's like doing this interview, but with articles.
Great. And guys, ladies, gentlemen, robots, whatever you are watching, wealthresearchgroup.com/2022. Link is in the description. It is an amazing report. And really, things are going crazy. And it's March 23rd right now at 11:12 a.m. Central Time. Silver's $24.97. Gold is $19.20 Where are we going, Lior? You think we're going to continue to inch upwards? You think the JP Morgan and everyone's trying to smack it down? Like, do you think, people are afraid of World War III and just not sure what to do? Like, what's your thoughts?
So let's divide it into two. Let's talk about what Wall Street thinks and then what retail thinks. So Wall Street, smart money, institutional money, the big money that moves markets is very, very pessimistic until last week. They really we're out of the markets, cash, alternatives, hedging, everything in January and February. I remind you, this was the worst January, February for the stock market since 1928, in 94 years, save for 2009, which had the worst January and February. We had the worst January and February in 94 years. So Wall Street was out. You had iOS changes, which impacted all the big tech companies. and the way that they can make money. The Omicron sent people home, and it brought a lot of supply chain constraints to the table. Then you had like record inflation month after month. And then you had the invasion. So all of these things, they created this crazy January and February. But the big one that stood above them all was, how will the Fed react to all of this? So the markets are falling. Are they going to tighten, or are they going to say, well, we can't tighten if the market's collapsing? Is this tightening into a recession? There was so much uncertainty about how the Fed will react to this, and that's what Wall Street was afraid of. About a week ago, with the rate hike, we got to see exactly what the Fed is thinking, and Wall Street loved what they heard. Since that time, the Fed has strategically sent out its most hawkish governors to scare the markets so that every possibility will be priced in. So at this point, when you look at stocks in the stock market, think of all the things that the markets are now already thinking and have already had a chance to sell if they wanted to. 7 or 8 rate hikes. 2 governors saying that we need 12 rate hikes in this year, or in other words, 3% for the Fed fund rate. We had a war in Europe with talks of small nuclear, hypersonics being used, cluster munition, NATO, crazy stuff in Europe. China, we know, people were thinking maybe it's going to use this chance and it's going to make its move on Taiwan. So literally World War III type scenarios were floating in the air. 40-year high inflation, and people are feeling it. Literally, people are hurting. And so the word recession was floating in the air. All of this is already known. So if you're an investor, you had a chance to panic and sell because of all of these. It would take something new to create the type of sell-offs that we've seen. So in terms of the stock market, I think we are in some sort of a wait and see period. The Fed is already raised rates once. It's probably going to raise rates in May and in June. And I think the markets want to see that what it's doing works to kind of normalize inflation. And only in the second half of the year, with the midterms and with better inflation data, if it comes, then I think the markets will resume a bull market. But for now, I think we are in this period where it's almost going to be 11 months since November, since the all-time highs, until September, October, that the market is going to be in a downward trend and going sideways. And last year's all-time highs, I think we will not hit them in 2022, maybe only in 2023. So that's my opinion on the markets. I think in terms of if you're a long-term investor with a 5 to 10 year rising, this is the time to be accumulating. And now in terms of gold and silver. So historically, if you look at the 6 rate hike cycles that we've had since 1971, 2 in the 70s, 1 in the 90s, we had in the 2000s, and then you had the 2015 to 2018 one, and now the 7th one that just started last week. In the previous 6 out of 6 times, gold prices have appreciated in rate hike periods. 6 out of 6. The average appreciation has been 30%. So if we take the price of gold a week ago, 1920, where we are today, 30% is almost $600. So if history repeats, just on average, we're looking at between now and the end of 2023, when the markets are starting to price at the end of the tightening cycle, you're looking at 2,500 gold. So I think we are at the beginning of an incredible move for gold. And here's 2 things to keep in mind. The retail public doesn't believe gold is going to go up. It went through an entire year, 2021, where all the reasons in the world for gold to go up didn't make it go up. In fact, it went down. So I think that the retail public didn't even participate in this rally that we just saw in the last 3 months to new all-time highs. I think the retail public is not yet participating. Certainly, it's not participating in silver, because if it were, silver would already be above $30 an ounce. So very weak retail participation, which is great because it tells you we're at the early stages of something and not like we were in 2020 in July and August, where everyone and their mother was buying gold and silver. So that's one thing. Secondly, if you Google biggest one-day inflow to GLD ETF, which tells you what the smart money is doing. GLD ETF has been around since 2004. So for 18 years, you'd think maybe Lehman Weekend, maybe the double dipper set, maybe COVID. No, January 24th of 2022, one of the worst days for the markets, was the biggest one-day inflow into the GLD ETF. So that tells you smart money is positioning for a big move in gold. And we had Byron Wayne, who's the lead strategist for Blackstone, and one of the legends on Wall Street. Like, you know, this is a real legend. He came out in January and said gold is going to surprise everyone. It's going to rise 20% this year. So we have a lot of things that tell us that Wall Street is actually very bullish on gold. Retail public not yet participating, and that's a great recipe for a lot higher prices. In 2015, when I launched Wealth Research Group, the Fed raised rates in December 2015. We started articles in January 2016, and we said the Fed is going to be very slow because there's a real risk that it will tighten into a recession. And the next rate hike was December 2016. It took a full year from the first rate hike to the second one. We are not at the same situation right now. This will be much more aggressive, and that will help gold a lot, because what people didn't understand about 2021 was that, as the Fed kept saying, we are not intervening. This is transitory, transitory, transitory. What they are telling you and doing with their actions is nothing. So smart money doesn't get into gold when the Fed is doing nothing. It gets into gold when the Fed is stressed out about inflation. And that's exactly what's going on right now. And that's why rate hike cycles are great for gold historically. Second reason they're great for gold is because the Fed has done a great job of telegraphing and signaling in advance what it wants to do. And by the way, in that report that you mentioned, wealthresearchgroup.com/2022, that's where I provide a lot of graphs and charts, and it's educational about all of this, everything I'm just telling you, and stuff we can't cover in an interview. But to go back, the 10-year bond is already at 2.4% right now. And that's because Wall Street is very good at already thinking months ahead. So it's likely that it's already priced about 80% of this 7 rate hike move that the Fed is telling you it's going to do in 2021. And that's really good, because if it's already priced in all this rate hikes, then the next step is for it to start pricing in rate cuts. And that's why these cycles are really good for gold as well, because the markets are forward looking and they're already starting to price in rate cuts in 2023. And obviously, lowering rates is really good for gold prices. So I think we're in a very good environment for gold. What's lacking for me are 2 things. One, the dollar is really strong because of what's happening in Russia. There's a flood to fiat currencies, specifically to the dollar. And I'm not talking about you and me. I'm talking about the big money. Secondly, what's missing for me is silver. We need to see silver above $30 an ounce to get a lot of the speculator money into this. And that's what will drive gold into 2100s, the 2200s, and will send silver towards the 36 an ounce, where I think it should be already. So that's my take on this. very bullish on gold and silver, and not so bullish on stocks for the next 6 months.
And that's what I was going to ask you too. Do you think silver is going to like jump on gold's trailer, or do you think gold's really depending on silver to get over that 30 to push it? And do you think that will happen?
I think that there's a lot of money parked in dollars, and it's weird because usually when oil is this good, it means that the dollar is really weak, but that's not the case. The dollar is really strong right now because oil is in like a price shock because of the war. And so I think once that starts to subside, people are going to use those dollars, and the dollar is going to weaken. You need to look at the DXY index and look for the dollar to go towards 90. 90 is that threshold between bull market and bear market. And so right now it's way above 90. It was already close, and then a lot of things changed. So one, I need a weaker dollar to see stronger silver. And I think we need more of the reopening of the economy, because velocity of money is so slow right now. It's the slowest in history. If you Google velocity of money, M2, you will see that it's fallen off a cliff during the virus, and it's not recovered, because America is a 72% consumer economy. 72% of GDP is consumer. And what do consumers buy? They either buy products or they buy services. During those the last 2 years, they only bought products. That's why the ports are so congested. Everybody's buying appliances or clothing or imports. People couldn't go to the nail salon to get a masseuse done. Everything that has to do with services was not done. Even if you wanted to commute to your lawyer, to your accountant, to this, that, no meetings were done. So the service economy, which is how you get velocity of money, because you stop at Starbucks, you stop here, you do this, you commute, money gets circulated in the economy. That didn't happen. If you just shop at an online store, it doesn't create velocity of money the same way a service economy does. So velocity of money is really, really slow. And once it becomes more normalized, I think the dollar weakens, and it keeps us on those elevated inflation levels. I want to remind you, though, that the CPI is a year over year or a month over month. What does that mean? So when the CPI is like 7% for the month of March, it compares to March of 2021. When you then think about March of 2023, inflation will probably be much lower than today, because another 7% means another 7% increase in prices. And so it just doesn't work that way. You don't get 7% on top of 7% on top of 7%, because that's hyperinflation, basically. So I think what people need to understand is that towards the second half of the year, because we're reopening the economy, that's actually deflationary and not inflationary. It creates a situation where you don't have these crazy used car sales that are double. You can buy a car and flip it for more as a used car. It doesn't work that way. A lot of these things, a lot of these interruptions with the chip manufacturers and with the truckers, those will start to subside. The problem that the Fed had was that they thought it would subside so much quicker than it really does. And I think this can last with us for another year and a half. And that's why I really think that the public will start to understand more about silver, because we are going through an inflationary boom. It's easy to see it everywhere. And when you start to do your research about inflation hedges, one of the first things you come across are gold, silver, and to the younger crowd, more of the digital assets. But it doesn't matter. You get so much of the economy to so many participants in the economy to look at silver. I don't know if you've seen this, but Ray Dalio, the billionaire fund manager, he put out a 1 hour informative YouTube video called The Changing World Order. Basically, the shift from west to east, China's going to be the dominant country, blah, blah, blah. It's been watched by over 7 million people. And I bet you, if you look at the analytics, there's a lot of millennials in there. And he talks about the gold standard, and he really is educating the younger audiences about the Nixon shock and things that most young people just don't know. So because they were born into the fiat monetary system, and unless they had some sort of a trauma, like I did in 2008, for example, you don't flock to that area of Barnes and Noble that quickly. So I think we're in a period where so many new people are getting introduced to silver. And that's where I think the next leg up for silver will come from people who have never bought silver and are either going to get introduced to it for the first time, or will hedge their stocks, their stock market portfolio, because it's just not going to perform well in the next few months with precious metals.
If you were somebody, that just found this video, just now getting into this world, and say you had like $3,000, how would you get exposure to gold and silver with like a $3,000 budget? Would you just go heavy on silver because you could get a lot more of it, thus maybe a lot, more crumbs of the cookie? Like, what would you do?
It's a good question. Well, certainly, if we're talking about $3,000 that are investable, in other words, this is not your last $3,000 or something like that.
Right.
It's $3,000 that you're looking to invest in precious metals. If that's the case, then I would lean on having that first ounce of gold in your hands as a long-term, basically a lifelong hold, because gold has compounded at 6.6% since 1971. That's really good. And it's compounded at around 8.9% since the turn of the millennia, in the past 22 years. So it's done amazingly well. And silver does not do amazingly well over time. It's compounded at 3.3%, which is not that amazing. And it just underperforms gold. Now, as a trade, silver is much better. So once you see the kickoff of a bull market, silver would do much better than gold because the size of the silver market is so small. So my opinion has always been, you go physical with gold and you go paper with silver. And with the paper gains, you flip them into more physical gold. That's how I have looked at this industry for the past 14 years. My short-term ideas are more silver related, and my longer-term ideas are more gold related. That's how I deem it. But because silver is really so cheap, if you have $3,000 and you just spent $2,000 or $2,100 on an ounce of gold, you could buy a few ounces of silver just to have it in your hand. That feeling of having silver in your hand for the first time and gold in your hand for the first time, it's a magical feeling. Like you understand the difference between that and government money instantly. It's a feeling you get. So it's a gut feeling you get that you made the right choice by diversifying into precious metals.
So you use silver in the short term to build your long-term golden kingdom is basically what your strategy is.
Yeah, because listen, let's take a look at 2009, for example. You had silver. When I got into silver, it was 15 an ounce. By the time I got selling, it was 42, 43, 44 an ounce. And I took those and rolled them into other investments, right? So think of the time it took for us to go from then till now. Silver is still not at that price. It's much more of a trade than a long-term hold. People that bought 10 years ago and 11 years ago are still, they're still not at 42 an ounce. So I think when the public starts to really like silver as a trade, that's when you need to capitalize. Now, if you're buying low and are not buying because of a mania, you're just dollar cost averaging every month, you buy a few ounces of silver, then all of this doesn't apply to you. You're just dollar cost averaging and building a lifelong silver position. So it just depends what you're looking to do. For me, what I did, I calculated how much our family unit spends on a given month. I multiplied it by 2 years or 24 months, basically. And I took that money and I converted it into physical gold and silver. So for example, if the family unit spends $5,000 a month, then you take that times 24, it's $120,000 in this example. And I converted that into mostly gold and some physical silver. And that is my lifelong gold silver position. When does it tweak? If my lifestyle rises and it's now not 5,000 but 6,000, for example, then I would adjust. And then a couple of years ago, I adjusted it further. I said I don't want this position to be less than 5% of my net worth. So I adjusted it up to being at least 5% of my net worth. So that's how I look at it. And when do I add to that? I may add to that on opportune times. So if you remember, September 2018 was a huge plummet in the price of gold. It went to 1180 for a day. I literally emailed my broker, my bullion dealer that day and bought gold. So if there's a real shakedown, a 25 to 30% shakedown in the price of gold and a 40 to 50% shakedown in the price of silver, I definitely buy more just because it makes sense. But otherwise, I think I have a really substantial position that I like. My next step would be to look into equities and mining equities or mining companies, gold stocks, silver stocks, etc. Because that's where you can get leverage to the price of the underlying commodity.
Yeah, I like that. Everything you said makes sense. I have kind of two questions for you that are totally opposite. The first one's a fun, quick question. What's your favorite physical, like gold and silver to stack? Do you do like government bullion? Do you do bars? What do you do?
I just do the Eagles.
Eagles. Okay.
Yeah. Keep it simple.
Keep it simple. Yeah, but a giant 100-ounce bar of gold in your hands. Come on, you do.
Look, my thing is where I live in Tel Aviv, we don't have the same culture as Americans do. When I came to America and I went into these bullion shops, I was like, is this the land or what? Like, this is amazing. He starts to explain all the numismatics and stuff like that. And it's an amazing thing. But, for me, it's fine for the moment to keep it simple.
Now back to mining stocks, and see what I did first in my journey is I went hardcore into silver. I building a physical silver stack, because here's the way I looked at it. And I'm just going to throw arbitrary numbers out there, but like, say, okay, the gold to silver ratio was like 80-1. So I could buy like one gold coin for $1,500 or 80 silver coins for say $20. And if those go up $5 a coin versus the gold going up by 200, so that's kind of like the way I had looked at it. You have a lot more chance for exposure, but the more I was stacking silver, purely silver, that I'm like, you know what, I need to get more exposure to gold. And on my video, I have top 5 mistakes of silver stacking. I tell people, hey, if you're going heavy into silver, what I wish I had done was said, every 100 ounces or every 500 ounces, I'm going to get an ounce of gold, that way you have that diversification. So I did that for a long time. So I've got a substantial, I've got over 6,000 ounces of physical silver and like 20 ounces of gold. But now, and I always say, like, I look at that as a hedge against inflation, not really an investment per se, but a way to preserve your wealth and buying power. Mm-hmm. So then I started looking into stocks, saying, well, stocks can actually be an investment in a way, like you said earlier, to really leverage or X up that return as long as you pick the right ones, right? So then I started dabbling in the stocks, and I started doing series of videos of like trying to find the best mining companies. So my question to you is, if gold, does the 2,500 and silver goes over 30, is it a sure thing as long as, you pick the right companies? Like, is it pretty safe saying if what I believe is going to happen with physical happens, we should see some sort of movement in the paper market. What's your thoughts on that?
Oh, absolutely. Absolutely. Uh, um, mining companies, there are four basic kinds of them. The exploration companies either have nothing. They literally bought a piece of land. Like you can buy a piece of land and they just start to drill it. And it's binary. It's either they strike something or they don't. So you're taking a lot of risk. And when you own an exploration company that hasn't proven anything, that's called grassroots exploration, you're literally taking the biggest risk. You are not an investor. You're gambling that these geologists are right about something. So I don't do those. Then you have exploration companies who have already found the deposit, but they think that either the other team that drilled for it in the past got it wrong, didn't look at the right data, didn't understand the data, whatever. They're trying to prove that whatever's beneath the ground is much bigger than what they bought. Let's say they bought an existing resource, but they think it's much bigger. So in that case, you're taking less of a risk because you are buying stocks in a company that does have a deposit, but you just don't know its size. So the speculation here is that, man, this could be much bigger than originally thought because we have so much better, modern technology today. It's so much easier to drill and really exhaust what's beneath the ground. The third type of company is a developer. So they already have such a nice deposit that it's actually economic to raise money and develop it into a producing mine. And so in that case, much lower risk because hey, this company is going to become a cash flowing business in the future, or somebody's going to buy it. A bigger company is going to buy it. So those are the developers. Then you have the producers. The producers are literally leveraged to the price of gold. Gold rises, as long as their expenses stay the same, their margins are getting bigger. They either pay a dividend or they buy another mine with the profits. You are part of a living operational gold company. And then those are the four main ones. Then there's the fifth category called royalty companies. And those companies are much less cyclical, much less dependent on the price of gold, and much more dependent on managements getting a lot of royalty deals done. Historically, the royalty companies have been the best performers in the whole mining sector over time. So if you Google gold royalty companies, you'll find the top three dogs. They're on all the articles, or you can find the smaller ones that are on the up and up. So what I try and do, if I am getting into a position with either of these types of companies, is I call the company. I speak with the management team. I want to know them. I want to know what they're thinking. I want to know what their exit strategy. I want to really get to know them, because what I'm investing in, though it's a public company, it's a venture capitalist type risk. It's a really big risk. You have to get the timing right, and you have to get of this cycle, and you have to make sure that these guys know what they're doing, because at the end of the day, think about it. It's a commodity. Everyone's selling the same thing. You find gold, I find gold. We're all finding the same thing. It's not like we have anything proprietary. So what I need is for this management team to be my competitive edge. So I want to know these people are ferocious and are engaged in this company and are shareholders of this company. I want to do some real research into diligence. This is not like buying shares of Amazon or something where you know what you're getting. Here, you can get anything from a bankruptcy to a bonanza, and that's the reason to do more due diligence when it comes to mining companies and take smaller size positions. So I keep it to 1% of my portfolio for any one company with a 40% stop loss. So let's say for $1 million portfolio, $10,000 per mining stock with a 40% stop loss. So the most I'll lose is 4,000 out of 1 million. And that's 0.4%. That's a risk I'm willing to take in this theoretical example, because the upside is I'm looking for companies that can do 5 or 6 times their current market cap. So you're either going to lose 4,000 or gain 60,000. And we're talking about not in years, but in a year or a year and a half. So it's not only that the risk is much smaller than the reward. In other words, it's a great asymmetric bet to take. To make 60,000 or lose 4,000, I'll take that all day. It's also the time capsule that it happens, because if gold goes from 2,000 to 2,500, what I just talked about, companies going up by 500-600%, it happens in weeks and months. That's it, and then the opportunity is gone. You have to wait for a whole new cycle. So you have to be ready for this. You have to allocate some funds in advance, and you have to wait. And once you get exposed to a mining company online with a friend, whatever, do your due diligence. If you've made a conscious decision, I think this is the one, or I think this is one of the 3, whatever, then you need to start building a position. And that's where a lot of people get it wrong as well, IS. What a lot of people do is they buy the whole position on day one. And that's just not a way to do it. If you have allocated 1% of your portfolio or $10,000 to a mining company, you need to buy a third on the first day and wait for the next news cycle. Let's see what they do. Let's see drill results. Let's see if they got over a regulatory hurdle. Let's see something positive, and you can increase that position and buy another 40%. So 3,000 in advance or 4,000 in advance, and then another 3,000. It also gives you a chance to dollar cost average down in case the share price starts to subside. If it goes up, then you did not build the type of position size that you wanted, but that's fine because you're making money. Okay, so it's okay either way. You have to realize it's never going to be perfect, but just don't think that this particular arbitrary day you bought is the bottom. And that's why I don't like to buy my entire position on day one. Okay, so that's a lot of like trading ideas, but I would say the one thing to do, call or email the company. Some of these companies, you'll actually speak with the founder or with the CEO. Ask them the good questions. Ask them like, what's next for the company? What's going to be the big catalyst? How much of the shares do you own? Are you personally right now buying? How does this compare? Who are your comparison companies, peer comparison companies? Let's see if they're cheaper. Let's see if they're more expensive. What else have you done in your life? Let's learn about you more. Do some research. Now, once you do a few phone calls like that, you'll be savvy enough where you can just look at a presentation and get an idea if you want to get involved. But I mean, this is the type of research you need to do if you're going into these types of companies. Now, here's where the magic happens, IS. If gold goes to 2,500, most of these companies are going to do well. So like a GDX or GDXJ ETFs, where it's a basket of these companies, they're going to do well. So at the right time and the right timing, a lot of these companies are going to do well just because there's so much buying pressure into such a small sector. So in a bull market, your job is way easier than in regular times. And I think we are entering into a massive bull market where it is going to be easier, but you should definitely, don't be indifferent about it. Do your research, make sure this management team is top of the class, that the operations are in a very safe jurisdiction, that they have the money to do the drilling or the development that they need. Learn more about them. There's a lot of ways to do it today where you can also join forums or chats and kind of throw these names around. People know them. Do the research. Go to conferences if you can. Now that the reopening is happening, because you'll see 40 or 50 booths of companies. You can speak with all these management teams. and learn more about them. So the more you do research on this, the next cycle, be it 2, 3 years, 4 years, 5 years from now, you'll have so much data on your hands that you'll know exactly which companies you want to get involved with. And obviously, if you want to get involved right now, then start by doing some research immediately, because we are going to see big moves. We are already seeing big moves. With our newsletter, for example, on January 3rd, I wrote about our number one company for 2022 to the readers of the free newsletter. That company went from $1.20 a share to $1.90. So we're talking about more than 50% in less than 3 months, while the markets have had their worst January and February since 1928. And this was a gold company. So if you do the research and find the right ones, it's definitely already game on for some of them.
Now, I want to ask you about your thoughts on digital currency and Fedcoin, but before I go there, are your trades public, or do you have a place on your website you post like what you're investing in? Do you share that info?
On the newsletter, yes, we publish the bull thesis for companies that we either are looking at or personally invested in or are working with in terms of to bring their business model to a wider audience. So yeah, definitely the newsletter is the best way to follow this.
All right, my plan is just to copy exactly what you do. Okay, going on to the next question. Fedcoin, okay, Fedcoin, digital currencies. I happen to think it's people or governments are definitely going to push for it for several reasons. One, mass taxation, right? No more like selling garage sale stuff and like not having to pay tax on, you should, right? Also, too, like max control, what we saw in Canada, locking down the truckers' bank accounts and these different things. So you could actually say, hey, people protesting in Sector 7 today, bang, you can't even spend money to get there. And, and then that ties into like, hey, if all cars are electric cars and they're all autonomous, can that be restricted for that type? But anyways, before we go down that rabbit hole, Fedcoin, digital currencies for governments, is it coming? And if so, what do you think are the biggest risks for us?
I think it's coming in a general sense. We are moving into a digital world, but I don't think it's gonna be something that I don't think it's something that's gonna happen in a matter of a year or 2 years or 3 years. It's more something that's gonna be in development for a few years to a decade or even more, especially in the United States. Most major changes with currency systems happen very gradually. There's a pilot, especially in an economy like the United States. You don't just introduce something unless there's a crisis. Nixon didn't take us off the gold standard because he woke up and thought it was a good idea. He did it because Kissinger told him that if we ever audit the Federal Reserve, then they'll see that we don't have 35 to 1 ratio here. We defaulted on that years ago. 1944, Bretton Woods, that was led by World War II. So 1913, the Fed was created because of a 1908 bank run, where the Rockefellers sent one of their in-laws to Europe, Nelson Aldrich, to study how they do it in Europe, and he came back with the idea of the central bank. So, I mean, it's all crisis. Bitcoin, crisis. It's all based on crisis. So I think a Fedcoin or something that's more digital, if it's launched the way the Fed wants it and the U.S. government wants it, it probably is going to be very gradual, with a pilot for a few years, then it may be introduced to the public in restricted fashion, etc. I don't think it's something that's coming right away. It's just too big of a project. The only thing that will change it is a crisis. I think you'll see it more in small countries where their currency system is rotten. Their people are unbankable anyways, undocumented. The third world or second world countries will start with it way faster than you'll see it from America. I think you'll see a lot of politicians keep asking the Fed about it, And I think you'll also see the Fed doing like academic papers on it and stuff like that, but nothing material will happen for years to come. They tried IS to get more information about your bank accounts. You remember that like a year ago, and the Republicans just told them no way.
Yeah, they're like, if you have $600 or more.
Yes,
that was crazy.
Yeah, this is America. So as long as the American the political system, for good or bad, keeps this checks and balances between more control and more freedom in check in America, you won't see it that quickly. There are obviously people that want to see it immediately, right? There are power hungry people that would love to see it yesterday, but for the majority of the public, if you tell them the risks of what this entails, it just will not fly.
You don't think we're all going to be plugged into the metaverse, just earning our little Fed coins?
There was a show. I don't know if you've seen that TV show, but
Ready Player One.
No, it's iRobot.
Oh yeah. I remember that.
It won Emmys and whatever, and it was about a company called Evil Corp, and they had the e-coin, and it was very real, like really legit, like how this would happen, and it happened because somebody tapped into the ledger of the banking system, and basically wiped out everyone's debts. So it was like being like a Robin Hood type. And he created such chaos that it backfired, and you had more government because of anarchy, etc. But anyways, save for an incredibly big crisis, I just don't see them introducing it and the public accepting it. The public accepted Bush's laws on privacy because of 9/11. Otherwise,
right.
It just won't fly. So you need to shock people to get this thing done, and I don't see it. We just had a few shocks, right?
Yeah, some major ones. Yeah,
we had a 5-minute break between pandemic and World War III. So I mean, we're already at pretty insane times. I don't see it personally, and I know your comment section will be on fire, but I just don't see it. And I talk to a lot of hedge fund managers and stuff like that. At this point, it's just one of those ideas that floats like SDRs. It floats, but it's All
right, last question I have for you, because I know we're running up against the clock here. Okay. But do you think millennials will turn to gold and silver, or have we lost them forever to cryptocurrencies? Can they be saved, Lior?
I think, look, we're in a good point. We're in a good position. The real world indicators that I'm looking at, like this Ray Dalio video and last year's silver squeeze on Reddit, on Wall Street Bet, if you remember that, January 2020. So I do see it happening. These millennials are in terms of the access they have to information, it's unbelievable. It's just unbelievable. They can do the amount of research that we used to do in a year. They can do it in a day. So yeah, there's a lot. Inflation is now in their faces. It's not something where it's talked about in a Mike Maloney book. It's, they see it. They see it at the pump. They see it here. They see it there. They see that they're in their 20s, and if they continue to earn a living that's up to par with the growth of the economy, they'll never save enough money. So that's why they speculate in NFTs and this and that. They try to change the game so that they can escape this. But one thing they will do is look at what has worked in other, or I don't think they'll look at that first. First of all, they'll start to understand what causes inflation. Then they'll realize it's printing money that does a lot of it. And then I think they'll research like other times that governments have printed money and what it helped the population to survive it. So I think that's how they'll get eventually to silver. And this could be something that happens in months, but certainly they're not the same as the boomers that lived through the 70s. It's not the same thing yet.
All right. How can people find you, and do you have any last words? Do you need to issue any critical alerts or warnings?
That question could be taken to the wrong way. How can people find you, and what are your last words?
I want your exact GPS court. No, okay. And where can people find more about what you do and your expertise?
No, I got you. So wealthresearchgroup.com is the newsletter. It's the website. You can sign up for the newsletter. On the top menu, you asked about like trades and stuff like that. We don't have trades, but on the top menu, if you click on the portfolio tab, you can actually see my portfolio. And there's another one called watch list, and another one called special reports, where it's like a wide array of PDF downloads. One of them being the one we talked about, the slash 2022. But there you can find in one hub, like all of them that we ever did for the past 6 years here. So that's how you can find, and the newsletter is how you can keep up to date 3 times a week with what's going on. Where if I speak with fund managers, CEOs of companies, and just do my own research and then encapsulate it into an article and blast it out to the readers. And the second question was, any last word? Okay, so no, I mean, look, we've done a lot of coverage here. I think the thing to remember with precious metals is you need to figure out which type of investor are you. If you're a trader, then you need to be focused on silver and be ready to time these things, because it's hard. You don't want to time the market, because the market, when they say the market, they mean the NASDAQ or the S&P 500, and because it doesn't do anything to time it. It's up 75% of the time, and it's literally, if you just plot it on a long enough chart, the market, or America, is in a perpetual bull market unless somebody decides to end the free enterprise system. Not so much with commodities. Commodities are not a buy and hold. They're a cyclical boom bust, very vicious on the downside, very euphoric on the upside. And so that's why commodities are notoriously where people have lost money and not made money if they're not able to emotionally go through this. So yeah, definitely my message is be ready for this to be a trade for you. Don't fall in love with this sector. This is with the mining stocks. With physical gold and silver, I think your agenda should be, or your goal should just be, to always have more and more of them, because you're saving them. This is a savings vehicle and not an investment vehicle. So if you look at saving in fiat currency versus saving in gold and silver, I don't think anyone would ever argue that a fiat currency is a better savings vehicle. It's just not, by definition and by design.
All right, Lior, thank you so much. This has been a truly fantastic discussion. I know the viewers are going to love it, but I know we both got to run. So what are we going to say?
Catch you in the next one.
Catch you on the next one. Woo!
One stacker on a journey